Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
Welcome to another episode of Intelligent Investor Insights. I'm Bob Barone, here with my co-host Josh. Today we're starting off with a good old-fashioned head-scratcher, the equity markets. You look at the numbers through early December, you'd swear Mr. Bull's running victory laps. Russell 2000 hits a record high on December 4th. Even the broader indexes closed the week positive. But, and this is a big but, we're still below the highs from late October and early November. I've seen this movie before. When tech and small caps start to lead into year-end, it's usually because they're playing catch-up, not because the next decade of growth is guaranteed.
Yeah, and you look at the headlines, Santa Rally, it sounds like we're all supposed to feel great, but under the hood, it's not that simple. Dad, you always say markets don't run on headline optimism. They run on fundamentals and actual corporate earnings, not wishes and seasonal cliches. Russell 2000's move, that's interesting, but it's still been trailing the big indices all year, right?
That's right. I mean, look, the so-called catch-up by small caps might excite traders who live for short-term moves, but let's not kid ourselves. The big indexes, despite eking out gains, didn't retake their highs. This rally after Thanksgiving is more about technicals and hope than any kind of robust, broad-based improvement. And I'll say it again, the major gains of 2025, they won't look like 2024. There are signs clear as day that things beneath the surface aren't as rosy as Wall Street wants you to think.
Yeah, it feels like the narrative keeps switching between everything's fine and brace yourself. And when you really look at it, if we're just chasing performance or buying into a seasonal rally without digging into the real data, that's a fast track to regret.
Exactly. Underneath these market moves, you've got consumer sentiment readings that are frankly dreadful. University of Michigan's numbers, 51 for November, 53.3 for December, are back to where they were during COVID, and more importantly, right around 1980 Carter-era lows. For context, November's was the second lowest on record. Josh, I don't know if people really appreciate what that means. That level of pessimism doesn't just come out of nowhere.
Yeah, that's the kind of gloom that usually makes families say, hey, let's skip the steak and buy ground beef instead. I actually remember a holiday season, I think it was the tail end of the last recession. Everyone's acting like it's business as usual, but at dinner parties, folks are bringing up coupon codes more than gifts. You're supposed to have this spending surge, but what you hear firsthand is, nah, we're cutting back this year. That disconnect between what the market's pricing in and how people actually feel, it's wild.
Spot on. And these sentiment surveys, they're not just so-called mood rings for the economy. Historically, they lead actual consumer behavior. If you see confidence this low, what usually follows is a pullback in spending. The real question is, does that show up this year, or does everyone power through one more holiday season before reality sets in?
Yeah, it puts all the market cheerleading in perspective, doesn't it? If everyone's feeling lousy but still opening their wallets anyway, it's just a matter of time before that catches up. But then the hard data comes in and throws everyone a curveball, right? You've got the TSA screening a record 17.77 million passengers over Thanksgiving week. That's not a subtle number. And Cyber Week, Adobe says $44.3 billion in online sales, a 7.7% year over year jump. So you see sentiment in the basement, but spending busting through the roof. How do you explain that?
Well, the narrative writes itself. Americans sad, Americans shop anyway. But let's not put the cart before the horse. A blowout shopping week or two doesn't rewrite the underlying trends. We're approaching what I'd call a spending climax. Everyone stretches one more time for the holidays, fueled by habit or maybe nostalgia, not real confidence. The record TSA screenings, the jump in online sales, I wouldn't call this real economic strength. It's more of a holiday-driven anomaly than anything resembling healthy baseline growth.
Yeah, it's like that adrenaline surge before you collapse on the couch. I mean, there's always something a little unnatural about the post-Thanksgiving period. People save up, they splurge, they show up in crowds, and then come January, they're dialing back, figuring out how to pay those bills.
That's right. The key is to not get blinded by big holiday data points. Just because spending is up 7.7% online doesn't mean consumers are flush. It means they're willing to binge on discounts, maybe even dip into credit just to feel normal. The real story will be how spending and delinquencies look after the holiday hangover. And speaking of that, you can already see the shifts. 3 million more people shopped at Dollar Tree in Q3 than last year. That's bargain hunting at scale, not everything's fine behavior. Sure, credit card delinquencies have come off their peaks, but they're still high. And if you look at auto loans and mortgages, it's even worse. Delinquency rates are climbing. Anyone saying the consumer is strong right now isn't looking at the right numbers.
Yeah, there's only so long you can stretch before something snaps. I mean, I talk to clients all the time. They're still shopping, but it's with a calculator in hand. And there's always that undertone of, what am I forgetting to pay this month? The surface might look good if you only squint at sales, but when you factor in those financial stress points, delinquencies, more folks seeking bargains, it's clear there's strain. And I might be wrong here, but doesn't this kind of frugality usually signal an inflection point in the cycle?
It does. This is textbook late cycle behavior, and anybody ignoring loan strain is missing the plot. The headline spending figures are masking a lot of pain underneath. Now, here's where I stay grumpy. Consumer inflation expectations. They're at 4.5% for the next year. That's way up from the 2.6% low in November 2024, though down from the wild 6.6% peak last June. And here's the rub. Inflation expectations matter more than the backward-looking CPI ever will. It's what people think prices will do, not what the last chart says, that moves behavior. And the Fed keeps missing that.
Right. And it's almost like the models they're using just keep assuming the expectations will fall in line. But look at the last couple of years. They haven't. The stickiness is real, and no one wants to think about how long expectations stay elevated, but that's what keeps everyone off balance. The Fed says, wait for the data, but that backward approach misses turning points every cycle, doesn't it?
Exactly. You can't solve a forward-looking challenge with rearview mirror models. Until expectations come down, inflation stays embedded. Simple as that. And that keeps rates from falling as quickly as some folks hope for.
And all this is happening with labor data that's, well, frankly, stale and murky thanks to the government shutdown. The most up-to-date stuff we've got is ADP's private payrolls. October, you had plus 47,000. That's already weak. Then November comes in at negative 32,000. Not only is that the third decline out of 4 months, it's also the worst 4-month streak since the pandemic. And if you look specifically at small businesses, under 50 employees, the losses are sharp, minus 120,000 jobs. If you're watching for economic turning points, that's basically your flare in the sky.
It's a sign nobody wants to see. Challenger Gray and Christmas report job cuts jumping 175% year over year in October. 153,000 jobs gone. And they're saying it's getting harder for those laid off to find anything new. The old story was lose a job, get a new one in a week. Now, the market's tightening up, and it's not just a blip.
Yeah, talking with clients brings it home. One guy, he'd work 16 years running warehouse ops, gets the axe, whole family has to pivot, slash spending, rethink what security means. It's numbers on a page until someone you know is living through it. Every stat has a ripple effect. Folks tighten up, drop plans for big purchases, all of which feeds right back into the broader economy. It's not just an abstract weakness, it's real life.
And I know it sounds cold, but rising unemployment, painful as it is, usually brings down inflation expectations faster than anything else. Still, you never root for it as a solution. That weakness is bleeding into business activity too. The ISM Manufacturing Index for November came in at 48.2. Anytime you're under 50, you're contracting. No spins, no maybe next month. The Industrial Production Index stuck. Up a hair in September, but with August negative, and we suspect October and November are at best flat, possibly sliding. It's not just manufacturing either. A stalling business sector means the foundation for corporate earnings is eroding right under the market's feet.
So if you're an investor, what do you do with that? The market's acting like future growth is a foregone conclusion, but with production flatlining and manufacturing contracting, the businesses that are supposed to drive those profits are just treading water or going under. At some point, that's got to matter for valuations, right?
It will. Right now, optimism is carrying portfolios more than earnings reality. For anyone listening, the lesson is be honest about what the data is telling you. Don't chase momentum into a business backdrop that's deteriorating. If anything, start thinking about how to position defensively. Focus on high quality, lower leverage, and don't kid yourself about where the real risks are buried.
And for the folks who've been through a few cycles, patience always wins. Defensive positioning matters more when the business engines stall, and you can't FOMO your way to lasting wealth. It's about staying power, not the next headline.
Exactly. All right, that's a wrap for today. But trust me, we'll be here dissecting every new twist as this market and economy keep moving. Josh, good conversation. See you next time.
Always a pleasure, Dad. And thanks to everyone for tuning in. Watch the data, stay patient, and we'll catch you on the next episode of Intelligent Investor Insights. Take care, Bob.
See you, Josh.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional level analysis, and a partner in building durable wealth. Reach out to start the conversation and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.